Hey everyone, welcome to Capital Pulse. Today we're talking smart investing tips, from diversification to avoiding emotional decisions. Whether you're a beginner or a pro, these insights will level up your investment game. Let's dive in.
Diversification is key. Diversifying across different assets, stocks, bonds, real estate, reduces the impact of poor performance in one investment on your overall portfolio. For example, if stocks decline, bonds or real estate may remain stable or even rise, providing a balance. Research before investing. Thorough analysis involves examining a company's financial statements, understanding its business model, and assessing the industry it operates in. Stay informed about market trends to anticipate shifts that might affect your investments positively or negatively. Long-term perspective. Having a long-term perspective helps you ride out short-term market volatility. It allows you to benefit from compounding returns, where your money earns returns on previous returns over time. Stay informed. Being well-informed helps you make strategic decisions based on a comprehensive understanding of the economic environment. Regularly monitoring financial news helps you identify potential opportunities or risks in the market. Risk management. Assessing risk tolerance involves understanding how much market fluctuation you can comfortably withstand. Adjusting your investments based on your risk tolerance ensures you don't take on too much risk or miss potential returns by being too conservative. Costs matter. High fees erode your returns over time, so it's crucial to consider the total cost of an investment. Choosing low-cost investment options, like index funds, can contribute significantly to your long-term returns. Continuous learning. The financial landscape is dynamic, with new investment products and strategies emerging. Staying open to learning helps you adapt to changes, seize new opportunities, and avoid outdated or risky practices. Emergency fund. An emergency fund, typically 3 to 6 months' worth of living expenses, provides a financial cushion. It prevents the need to sell investments in a downturn to cover unexpected expenses, allowing your long-term investments to continue growing. Avoid emotional decisions. Emotional decisions, driven by fear or greed, can lead to actions that harm your portfolio. Sticking to a well-thought-out investment plan helps you avoid knee-jerk reactions that might undermine your financial goals. Professional advice. Financial advisors can provide personalized guidance based on your specific financial situation and goals. They can help you navigate complex financial markets, provide insights into tax implications, and assist in creating a diversified and well-balanced portfolio.